Hello everyone. Today we will start remaining part of analysis of balance sheet. The asset side of balance sheet. In the previous video, we look at the liability side of the balance sheet in detail. We will now proceed to understand the second half of the balance sheet, that is the asset side of the balance sheet. The asset side shows us all the assets the company owns right from its inception. Assets in simple terms are the resources held by a company which help in generating the revenues. Here is the snapshot of the asset side of the balance sheet. As you can see, the asset side has two main sections, that is non-current assets and current assets. Both these sections have several line items included within. We will look into each one of these line items. Non-current assets. Fixed assets. Similar to what we learned in the previous video, non-current assets talks about the assets that the company owns, the economic benefit of which is enjoyed over a long period of time beyond 365 days. Remember, an asset owned by a company is expected to give the company an economic benefit over its useful life. If you notice, within the non-current assets, there is a subsection called fixed assets. With many lines item under it, fixed assets are assets, both tangible and intangible, that the company owns, which cannot be converted to cash easily or which cannot be liquidated easily. Typical examples of fixed assets are land, plant and machinery, vehicles, building, etc. Intangible assets are also considered fixed assets because they benefit companies over a long period of time. If you see, all the line items within the fixed assets have a common note, number 10, which we will explore in greater detail shortly. Here is the snapshot of fixed assets of Amar Raja Batteries Limited. The first line item, tangible assets, is valued at 619 crore rupees. Tangible assets consist of assets which has a physical form. In other words, these assets can be seen or touched. This usually includes plant and machinery, vehicles, buildings, fixtures, etc. Likewise, the next line item reports the value of intangible assets valued at 3.2 crores. Intangible assets are assets which have an economic value but do not have a physical nature. This usually includes patents, copyrights, trademarks, designs, etc. Remember, when we discussed the P&L statement, we discussed depreciation. Depreciation is a way of spreading the cost of acquiring the asset over its useful life. The value of the assets deplete over time as the assets lose their productive capacity due to obsolescence and physical wear and tear. This value is called the depreciation expense, which is shown in the profit and loss account and the balance sheet. All the assets should be depreciated over its useful life. Keeping this in perspective, when the company acquires an asset, it is called the gross block. Depreciation should be deducted from the gross block, after which we can arrive at the net block. Net block is equal to gross block minus accumulated depreciation. Note, the term accumulated is used to indicate all the depreciation value since the incorporation of the company. When we read tangible assets at rupees 619 crores and intangible assets at 3.2 crores, do remember the company is reporting its net block, which is net of accumulated depreciation. Have a look at the note 10, which is associated with fixed assets. At the top of the note you can see the gross block, depreciation, amortization and net block being highlighted. I have also highlighted two net block numbers which tallies with what was mentioned in the balance sheet. Let us look at few more interesting aspects on this note. Notice under tangible assets, you can see the list of all assets the company owns. For example, the company has listed buildings as one of its tangible assets. As of 31st March 2013, ARBL reported the value of the building at 93.4 crores. During the financial year 14, the company added 85.8 crores worth of building. This amount is classified as additions during the year. Further, they also wound up 0.668 crores worth of building. This amount is classified as reductions during the year. Hence, the current year value of the building would be previous year's value of building plus addition during this year minus deduction during the year. That is equal to 93.4 plus 85.8 minus 0.668 is equal to 178.5 crores. Do remember, this is the gross block of the building. From the gross block, one needs to deduct the accumulated depreciation to arrive at the net block. In the snapshot, I have highlighted the depreciation section belonging to the building. As of 31st March 2013, ARBL has depreciated Rs 17.2 crores, to which they need to add 2.8 crores belonging to the year FY14. Adjust 0.37 crores as the deduction for the year. Thus, the depreciation for the year is previous year's depreciation value plus current year's depreciation minus deduction for the year, that is equal to 17.2 plus 2.8 minus 0.37. Total depreciation is 19.736 crores. So we have building gross block at rupees 178.6 crores and depreciation at 19.73 crores, which gives us a net block of 158.8 crores. The same exercise is carried out for all the tangible and intangible assets. The next two line items under the fixed assets are capital work in progress, that is CWIP, and intangible assets under development. CWIP includes building under construction, machinery under assembly, etc. at the time of preparing the balance sheet. Hence, it is aptly called the capital work in progress. This amount is usually mentioned in the net block section. CWIP is the work that is not yet complete, but where a capital expenditure has already been incurred. As we can see, ARBL has 144.3 crores under CWIP. Once the construction process is done and the asset is put to use, the asset is moved to tangible assets from CWIP. The last line item is intangible assets under development. This is similar to CWIP but for intangible assets. The work in process could be patent filing, copyright filing, brand development, etc. This is at minimal cost of 0.3 crores for ARBL. All these costs are added to arrive at the total fixed cost of the company. Non-current assets, other line items. Besides the fixed assets, under the non-current assets, these are other line items as well. Non-current investments are investments made by ARBL with a long-term perspective. This stands at 16.07 crores. The investment could be anything: buying listed equity shares, minority stake in other companies, debentures, mutual funds, etc. Here is the partial snapshot of Note 11. This gives you a perspective. The next line item is long-term loans and advances, which stands at 56.7 crores. These are loans and advances given out by the company to other group companies, employees, suppliers, vendors, etc. The last line item under the non-current asset is other non-current assets, which is at rupees 0.12 crores. This includes other miscellaneous long-term assets. Current assets. Current assets are assets that can be easily converted to cash and the company foresees a situation of consuming these assets within 365 days. Current assets are the assets that a company uses to fund its day to day operations and ongoing expenses. The most common current assets are cash and cash equivalents, inventories, receivables, short term loans, and advances. This is the snapshot of the current assets of ARBL. The first line item on the current asset is inventory, which stands at 335 crores. Inventory includes all the finished goods manufactured by the company, raw materials in stock, goods that are manufactured completely, etc. Inventories are goods at various stages of production and hence have not been sold. When any product is manufactured in a company, it goes through various processes from raw material to work in progress to a finished good. Snapshot of note 14 associated with inventory of the company is as shown. As you can see, a bulk of inventory value comes from raw material and work in progress. The next line item is trade receivables, also referred to as accounts receivables. This represents the amount of money that the company is expected to receive from its distributors, customers, and other related parties. The trade receivable for ARBL stands at 452 crores. The next line item is cash and cash equivalents, which are considered the most liquid assets found in the balance sheet of any company. Cash comprises of cash on hand and cash on demand. Cash equivalents are short-term, highly liquid investments which has maturity date of less than 3 months from its acquisition date. This stands at 294.5 crores. Note 16 is associated with cash and bank balances is as shown below. As you can see, the company has cash parked in various types of accounts. The next line item is short-term loans and advances that the company has tendered and which is expected to be repaid back to the company within 365 days. It includes various items such as advances to suppliers, loans to customers, loans to employees, advance tax payments, that is income tax, wealth tax, etc. This stands at 211.9 crores. Following this is the last line item on the assets side and in fact on the balance sheet itself. This is the other current assets which are not considered important, hence termed other. This stands at 4.3 crores. To sum up, the total asset of the company would now be fixed asset plus current assets, that is 840 plus 1298 crores is equal to 2139 crores, which is exactly equal to liabilities of the company. With this, we now run through the entire asset side of the balance sheet and in fact the whole of balance sheet itself. Let us relook at the balance sheet in its entirely. As you can see in the above, the balance sheet equation holds true for ARBL's balance sheet. Asset is equal to shareholders fund plus liabilities. Do remember, over the last few chapters, we have only inspected the balance sheet and the P&L statements. However, we have not analyzed the data to infer the numbers are good or bad. We will do the same when we look into the financial ratio analysis in upcoming videos. Connecting the P&L and balance sheet. Let us now focus on the balance sheet and the P&L statement and the multiple ways they are connected to each other. On the screen above, on the left hand side, we have the lines item on the typical standard P&L statement. Corresponding to that, on the right hand side, we have some of the standard balance sheet items. From the previous videos, you already know what each of these line items mean. However, we will now understand how the line items in the P&L and the balance sheet are connected to each other. To begin with, consider the revenue from sales. When a company makes a sale, it incurs expenses. For example, if the company undertakes an advertisement campaign to spread awareness about its product, then Naturally, the company has to spend cash on the company. The money spent tend to increase the decreased cash balance. Also, if the company makes a sale on credit, the receivables go higher. Operating expenses includes purchase of raw material, finished goods, and other similar expenses. When a company incurs these expenses to manufacture goods, two things happen. One, if the purchase is on credit, then the trade payables go higher. Two, the inventory level also gets affected. Whether the inventory value is high or low depends on how much time the company needs to sell its product. When companies purchase tangible assets or invest in brand building exercises, the company spreads the purchase value of the asset over the economic useful life of the asset. This tends to increase the depreciation mentioned in the balance sheet. Do remember, the balance sheet is prepared on the flow basis. Hence, the depreciation in balance sheet is accumulated over year and year. Please note, depreciation in balance sheet is referred to as the accumulated depreciation. Other income includes monies received in the form of interest income, sale of subsidiary companies, rental income, etc. Hence, when companies undertake investment activities, the other income tend to get affected. As and when the company undertakes debt, the company obviously spends money towards financing the debt. The money that goes towards financing the debt is also called finance cost or borrowing cost. Hence, when debt increases, the finance cost also increases, and vice versa. Finally, as you recall, the profit after tax (PAT) adds to the surplus of the company, which is a part of the shareholders' equity. In the next video, we will look into the last financial statement, which is the cash flow. Thank you for watching this video. Please do like, comment, and share this video to your friends and relatives. Also, don't forget to subscribe to my channel.